Coming back to Borivali Central CPE Study Circle. Uh, it's a pleasure coming back here, and I recall my days as a core group member, and today presenting on a topic for Borivali Central CPE Study Circle is a huge moment of pleasure for me. So while Kinjalba has introduced the gift city jurisdiction and what benefits it entails for various sectors, we will in this session specifically focus on alternative investment funds. I'm sure many of you would be aware of what this asset class has been, what this new kid on the block, so to say. Now it's almost a decade, more than a decade that it has been around here, but still it's a kind of a new kid on the block and what it entails for us. Before we understand the AIF regime in Gift City, it is more or less similar to what SEBI has been regulating over a decade here. So let's understand what AIF generally, in general, for a SEBI regime or an IFSC regime would be there. So to start with, to define AIF, this is the same definition that has been there in your AIF regulations of SEBI. SEBI Alternative Investment Fund is a privately pooled investment vehicle where you pool money from investors, whether Indian, foreign, for a specific investment purpose. It is what it does not cover. This is not mutual fund. So anything that is regulated under mutual fund regulations is not AIF. Anything that is regulated under collective investment scheme of SEBI is also not AIF. So any asset class which is pooling money other than mutual fund and CIS qualifies as AIF. Again, AIF is something that is not a family trust which is set up for the benefits of relatives. While there is a trust structure included in AIF, but if there is a trust which is only for the benefits of the relatives that has been set up, it is not considered AIFs. ESOP trust is very popular among startups now to give some portion of equity to its key employees there. So ESOP trust again is excluded here. Employee welfare trust or gratuity trusts. Your holding companies, where holding companies may have multiple shareholders there, but a holding company setting up a subsidiary company is not considered as an AIF again. And other special purpose vehicles which are separately regulated under some other regulatory framework. So that's what AIF is. Let's understand the structure options. AIF can be set up as a private limited company. So under a private limited company, all investors become your shareholders. It is governed by Companies Act. And because of that nature, it has its operational challenges. Every time a new investor comes in, you have to do your private placement processes, your pass-through filings, your board meetings. So every time you have to onboard a new investor, it becomes operationally difficult there. LLPs, again, permissible, but its own operational challenges. Every time an investor is onboarded, you amend your partnership deeds, get all your investors which are a partner in the firm to sign the deed, your Form 3, Form 4 filings. Business trust. Investors are unit holders with limited liabilities. It has operational ease. And in India, AIF structure is the most popular structure that has been set up. So let's understand what are the constituents and ecosystem components of AIF. So what happens and we are going to focus here on the trust structure predominantly because that's what has been prevailing in the Indian ecosystem. So to set up a trust, we all know that you need a settler and a trustee appointed. Settler appoints the trustee, they both enter a trust deed and register it. That's where the trust comes into picture. Once the trust is registered, your investment manager is basically the brainchild of the entire AIF structure because that's what he's been conceptualizing, that's what his vision has been. But he needs a trustee and a settler to set up the trust. They need to be independent. They can be, trustee, investment manager himself can become a trustee, but SEBI does not look it in a very friendly manner. So it is advisable to have an independent trustee appointed there. Again, sponsor is something that you need to set up a trust. Sponsor is basically the person who puts in the promoter's capital. So later in the slide, we will see that there is a requirement that when you are setting up an AIF, especially category 1 or category 2 AIFs, the promoter's capital has to be 2.5% of the corpus or 5 CR, whichever is less. So you need somebody to put in this capital. Investment manager and the sponsor can be same entities, but if the manager does not have a sufficient net worth of his own, he can bring in some people together and they form a sponsor entity to set this up as a sponsor. Again, this can be a private limited company, this can be individuals, this can be LLPs. It is open for how you structure it. Of course, everything comes with the blessings of lawyers and tax advisors. Nothing works without their blessings. So lawyers and tax advisors are there to structure your entity, and while they will be the one who will be helping with drafting of various documents. So this application documents, your private placement memorandum. Private placement memorandum is again the charter document of the AIF, and you need some net worth certificates for a sponsor, etc. And a merchant banker. So the private placement memorandum that is now being drafted needs to be certified by a merchant banker before you make an application. So merchant banker will just ensure that the terms of the PPM are in lines with the SEBI guidelines or what SEBI has been recommending the way your PPM has to be. So once this everything is compiled and application is made with SEBI, once you get the approval from SEBI, your AIF is born. So that is where your SEBI registered AIF is born once this application is approved. Post AIF is registered, what are the stakeholders in the ecosystem? So there are some fund administrators. Fund administration again is optional. You may have your own accounting team, your own investor relations team, and you can do it in-house. But there are some very popular fund administrators available in the market who are specifically providing these services, which entails your fund accounting, your computation of NAVs, your investor relations, your compliances with FEMA, SEBI, income tax. RTA, which is register and transfer agents, which are for your stamp duty payouts and for your demat accounts, etc. Custodian, so above a certain, so the earlier when the regime was started, there was a certain threshold that if your fund is above 500 CR and above, you need a custodian, but now it is mandatory for all AIFs to have a custodian. The most important constituent here, without investors, nothing works. So you need investors to invest into your vehicle, which is usually the sponsors are called your general partners because they are the promoters, they are putting in that promoter capital. And so GPs in common terminology, and investors, your other investors are your limited partners, LPs, because they have limited exposure, limited risk, and of course the limited rights as well. So these are your HNIs and corporates, family offices, fund of funds, institutional investors. You have a lot of domestic institutional investors who are now taking exposures to this asset class. The key documents here are trust deed is signed between the settlor and the trustees to give existence to the trust. Then there is an investment advisory agreement which is signed between your trustees and the manager that all the rights of operational day-to-day activities are given to the trustee per se is primarily responsible for compliances of the trust, but trustee vests all these powers in investment manager by way of an investment manager management agreement to take care of day-to-day activities, compliances, all investment decisions to trustees. Then investment manager in turn signs an investment advisory service agreement with the trust where by way of compensation gets management fees. Then there is something called as investment committee, which is important to constituent in an AIF. Investment committee is kind of committee of some domain expertise professionals in the industry where say for our AIF we are specifically focused on tech investments. We do only B2B tech. So we have some tech stalwarts on our investment committee. Whatever investment proposals we have, we will take up to that committee for discussion. There are some questions, there are some clarifications. If we are able to justify our investment thought process behind this particular portfolio company, it gets approved, or there are some further study or research needs to be done. So basis those investment committee approvals only, then your investments gets processed. So the whole idea here is there, while it is a trust, it is in the fiduciary capacity for the investors that our investment manager is acting. So the idea of trustees governance, investment committees, all that, I am not doing any related party transactions if I am investing into my cousin's company, or if I am giving some preferential terms to my say friend who has been setting up a startup, and I'm not deviating from my thesis, is something that this all the stakeholders are governing here. And once the investment start, with investors you sign a contribution agreement which states down your commercial terms, your rights, your obligations, and basis that contribution agreement, the investments are made into the fund. And once the monies are received into the fund, you deploy that capital to whatever your investment thesis have been. So to deploy that capital, the documents, key documents, there are shareholders agreements signed, there are share purchase agreements signed. For debt securities, there are debt agreements and share warrant agreements as well. So let's understand this documentation process. What are the key documents here? One is your charter documents. For a trust, you need a trust deed. If your manager or a sponsor is an LLP or a company, you need your memorandums and articles, your LLP deeds. Investment management agreement we spoke about is signed between the trustee and the investment manager, which gives them in a way of power of attorney to operate the fund basically. Private placement memorandum, again a very key document in the whole process, and nowadays SEBI has been very vigilant in terms of how your PPMs are defined, what are the terms included there. So some of the popular terms are that what is your corpus defined, what is your green shoe option. Green shoe option is basically how much oversubscription can you take into the fund. If your fund is say 200 crores and then your green shoe is defined for 100 crores, maximum money that you can take from investors is 300 crores. If you are still oversubscribed, you may have to approach SEBI to change those limits. Carried interest is something what a fund manager or the investment manager gets as a proportion from the profits that are generated. This is over and above your management fees or operating fees that you would be charging to the fund. So usually, to give you an example, what happens if, say, if somebody has invested $100 into the fund, and over 2 years, say the fund generates an exit of at 300 rupees. So there is technically a profit of 200 rupees that the fund has generated. So some of the nowadays fund managers are very innovative in structuring this what carried interest proportion they would be getting, but the standard structure is 220. That is how it is defined. 2% is the management fee and 20% is profit share. So out of this 200 rupees, the profit that has been generated, 80%, which is 160 rupees, goes to the investor, and 40 rupees is retained by the fund manager as its portion of carried interest. Hurdle rate, again, is a minimum return that is committed by a fund manager to the investors. So until that hurdle rate is delivered, fund manager does not get any portion in the profits there. So in our example, say if the investment value was say 100 rupees, and over 2 years, say if instead of 300 rupees, the exit value is only say 125 rupees. And if my hurdle rate is say, for example, 15% for 2 years, so on simple interest basis, it becomes 30 rupees. So 100, first year 15, second year 15, for 2 years it is 30 rupees. But only what I have generated is only 25 rupees of profit. So that entire 25 rupees will go to the investor and nothing will go to the investment manager, because the manager is not able to generate that minimum hurdle rate return there. So hurdle rate is something, a minimum return which is committed by the fund manager to the investors, and only once it is delivered, fund managers get a certain portion in the profits that are generated. Your management fees, operating fees is something you need to define in your PPMs. Closing, first closing and final closing. What do you mean by that? So first closing is a time frame when you launch the fund and you then up to a certain date announce with SEBI that this is the corpus that we have collected. So say if I have promoted a fund which a total corpus of say 100 crores, and while I start marketing my fund, pitching my fund to the investors, and I start getting investments, and say by 25 crores, once I reach 25 crores, I need to make deployment. So until I communicate to SEBI that, okay, this is the certain portion of corpus that I have raised and now I want to start deploying these funds, I have to first intimate SEBI of this closing. this is my first closing of the fund, 25 crores is my raised capital, and I am going to start making commitments out of it. So as per the regulations, this first closing needs to happen within 12 months from the date of the approval received. So it is not that something, it can be a very open-ended fund or a infinite period until which you start keep raising this money. So first closing usually happens, or not usually, I mean it is now defined in the PP regulations as well. First closing needs to happen within 12 months from the date of the approval, and final closing of the fund is within 24 months from the date of the first closing if something happens. Of course, there are provisions that with a certain majority investors approval and all, you can extend these terms, but within a certain time frame, you need to announce this first closing and final closing. So basically the intent here is that it is not that while the initial investors who have committed to the fund, but beyond a certain point in time, if the fund manager is not able to raise capital, those initial investors get locked up into the fund. So in the interest of the all retail investors who are investing into the fund, there are certain time frames within which certain action needs to be happened. Commitment period again is the time period in which the fund manager needs to make commitment of capital for deployment of capital, and if it is not making that commitment of for deployment of capital, then after a certain point in time you can't deploy further capital if you have not already committed for it. So again, to explain how this works, I mean, say if I am a fund manager, I am looking to invest into a startup, say 50 crore rupees, but I don't want to make all investment in one go because I want to see how the growth is happening, what scale is being achieved, whether there are certain milestones that a founder is able to achieve. While I may commit him the 50 crore check, the first tranche will be always 10 crores or 15 crores, and basis certain milestone that he is able to raise, maybe next 6 months or 12 months, I will give him the second tranche of investment because there is certain growth that is visible. So all these commitments need to happen within that commitment period. The tranche portion of it can go later, is fine. So all these things are defined in your PPM in very detail. Again, PPM, then the credits or the standings of your investment committee, your trustees, your fund manager, what is their background, what is their domain expertise, all those things come into play. Another thing is investment committee I mentioned about. Your investment committee minutes of the meeting needs to be recorded and stored very carefully. SEBI audits may require you to submit this minutes of the meeting, how these investment decisions were taken. Contribution agreements with your investors, it will define your commercial terms, it will define your obligations, your rights, obligations of the investors, rights of the investors, what information rights they have. Everything is defined in the contribution agreement. Side letters are something, some special arrangement that you do with this investors is captured in side letters. So under investors category, there is always a class of units that are defined. So for a particular class, the commercial terms needs to be same. So if there is an investor who is committing say 1 crore to a fund, or vis-a-vis investor who is committing 10 crore to a fund, may not always have same rights, because the 10 crore investors may want certain extra rights, extra governance rights, information rights. So usually these are categorized into different classes of units. Within that classes, if certain investor is investing, say for an institutional investors, like say a lot of banks are taking exposure to asset class. For banking purposes, they have certain requirement that certain reports and information needs to come from the fund regularly. So all those extra rights and conditions that are there, which are specifically for that investors, are covered, usually kept outside the contribution agreement and covered in the side letters. Beyond that, there is deals. I mean, whatever investment we are deploying, whatever the research notes are, and whatever our IC presentations are. Of late, we have seen SEBI asking for that as well, that what was your research conducted. I mean, they want to know that it was not that, I mean, just one morning I get up and I decide that, okay, in this particular company I will invest my money. So your research notes have to be very detailed. Your IC presentation has to spell out everything that you intend to deploy this capital. Coming to deployment of capital, your shareholders agreement, your share subscription agreement, share purchase agreements, everything is being designed for a particular purpose. Your share subscription agreement, which is SSA, is basically a agreement between the investor, I mean for the portfolio company. As a AIF, we are the investors, so investors, the portfolio companies and the founders, on what terms and on what price this investment has been made. Shareholders agreement is a little wider document which will cover your rights as an institutional investors. You may have certain board rights, you may have certain minimum exit rights, you may have certain special rights to secure your investment or the returns there, wherein all the existing shareholders on the cap table will agree to that certain rights is defined in the shareholders agreement. Share purchase agreement is usually used or as an instrument when there is a secondary transfer of shares. So I may not be buying as a primary, I may not be putting a primary capital into a portfolio company or doing my private placement or arrangement, but I may be buying it from the existing shareholder. So when there is a transaction between two shareholders, an incoming and an outgoing shareholder, that is where mostly the share purchase agreements are used. Of course, for your debt securities or debt funds, you have share warrants and debt security agreements. And then there are other investor communications which you will see later in the slide, or the key or the popular investor communications being sent out. Category wise, there are three categories where AIFs are defined. So category 1 AIF is mainly focused on your early stage venture investments, something that has a positive spillover on the economy, your employment generation agenda. It pushes the employment generation agenda for the government. Mainly invests in unlisted securities in private sectors. Popular funds in these categories are your venture capital funds, your SME funds, social venture funds. And there are a lot of incentives that are also given by SEBI and Government of India to promote this category. Category 2, we will take it up a little later. Category 3 is something which is totally opposite of category 1. In category 3, it is more complex trading strategies that are being employed, leverage is being employed. So your hedge funds, your private investment in public enterprises, public investment in private enterprises, etc. All these complex trading strategies and complex investment structures are categorized as category 3. Category 2 is the residual category, which stays something that is not category 1 or category 3 is category 2. So they have not clearly defined it, but usually your private equity funds and debt funds are categorized as category 2. Now, what is the difference between a venture capital fund and a private equity fund? So venture capital is mainly a financial investor, once I put in my money, I don't get into day-to-day operations of the startup. I'm just a financial investor into the portfolio company is your venture capital, and in due course, in 3, 4, 5 years, whatever my investment horizon is, I tend to get my returns on that investment. Private equity is a little more operational focused. Along with the capital that is being invested, they are also looking to take operational control of the startup. They want to drive this product or this technology to a certain level and make sure that their returns are generated. So private equity funds are usually looking to take more than 51% control by way of whatever capital they are putting in. No specific incentives by SEBI or government for this category, but of late it has been a very popular category because most of these venture capital funds are graduating to take your operational controls as well, because they want to secure those returns for their investors. Key differences here: your registration fees vary depending upon what category you are. So angel funds again are smaller funds with smaller ticket sizes, smaller corpus, which are again a subset of category 1 AIFs. Is something that you start with 2 lakhs of registration fees, and for category 3 it goes as high as 15 lakhs rupees. Sponsor commitment, which we spoke of earlier, for category 1 and category 2 funds, it is 2.5% of the corpus or 5 crores, whichever is less. For angel fund, it is only 50 lakhs. For category 3 funds, it has to be 5% of the corpus or rupees 10 crores, whichever is less. Tenure, The regulations only define minimum tenure for category 1 and category 2 funds, which is 3 years minimum tenure. It does not define a outer limit. Usually, these funds have been 10 years life cycle, plus there are some 2 years extension that was available with the approval of the supermajority investors. So this is a very typical time frame in terms of this journey as well. So these AIF regulations were notified in 2012, and whatever funds that were set up in 2012 under this AIF regime, 2012 2013 funds, that 10-year cycle ended in 2023 with 2 extensions available. 2025 is a time frame now, with extended period is also coming to end. These funds are coming to the end of their life cycles. So very particular situation where what happens if you are not able to liquidate all your assets, if you are not able to convert these assets, these securities, this your CCPS, your equity shares, your CCDs that you have invested into this company, you're not able to liquidate them. How do you return money to these investors? So there are a lot of representations being made to SEBI. They need more extension. They need some other way out. So a lot of this early funds like Bloom Ventures, you have Excel Partners who are operating in Indian ecosystem for a while. They are now coming up with a continuation fund. So what is a continuation fund? That the new fund buys the securities from the old fund and gives them that money. Of course, everything happens with the approval of the SEBI. It is not that कि मैंने first fund का securities मेरे second fund को बेच दिया and I just generate profit. That needs to happen with the blessings of the SEBI. Once SEBI allows that is only when this happens, and also the investors of the new fund and old fund both agreeing to it. So that is one of the way out, that continuation funds are being set up lately to address this issue of end of fund life. And then there is in-specie distribution. If the AIF has a limited amount of investors which are with a little larger ticket sizes, and if all these investors agree, they can take up this securities itself. So I can give my CCPSs, my equity shares to these investors in the pro rata of their investment into the fund, and for them to directly hold this. Why is this possible? Because category 1, category 2 funds are also enjoying pass-through status, while category 3 is taxed at the fund level itself. What is a pass-through status? We all understand that for category 1 and category 2 funds, there is no capital gains accruing. Even if I was to liquidate these assets, there is no capital gains accruing at the fund level. Everything is taxed at the individual investor level. I mean, as if they had directly made these investors. So because of that, it is also possible that while I am not able to liquidate these assets by the end of the fund life, I can do an in-specie distribution, which is that I will, if I have 100 shares of a particular company and I have 10 investors on my cap table, each investor I can distribute pro rata, assuming that investment amounts are also similar. So all those options are available there. Minimum corpus. Category 1 and category 2 funds have to be at least for 20 crore rupees. Category 3 as well has to be at least for 20 crore rupees. Angel funds can be 5 crores there. Category 1 and category 2 funds are closed-ended fund. Category 3 funds can be open-ended, can be closed-ended, based on your investment strategies. Overseas investments from an domestic AIF is possible with the approval of SEBI. SEBI has a single window clearance authority where you don't need to go to RBI separately for making these investments. All your limits are monitored by SEBI itself. Leverage is not allowed in category 1 and category 2 funds. Category 3 funds with certain conditions fulfilled and under certain parameters, leverages are allowed. Last point, diversification. So whatever the fund corpus is there, not more than 25% of the corpus can be invested into one particular company. Again, this is to make sure that your portfolio is fairly diversified, your risk mitigation techniques are in place, you are not taking too much concentration or too much bet on a particular company, because if that were to not succeed, this investment, it has a potential to bring the entire fund down. Overseas structure, Kinjalbhai introduced Gift City to us. So before Gift City, there were certain features for which overseas structures were defined, was to tap foreign capital for Indian markets, provide operational ease. So instead of an investor coming directly into my Indian AIF, it always preferred coming through a offshore structure somewhere in Mauritius or Singapore, because it has less compliances, less exposure to Indian regulatory authorities, and it provided a lot of ease for these investors. It prevented exchange rate fluctuations as well. Unified structure and co-investment structures are kind of structures through which these investments were made. I think Jugalbhai should take it in his session how it differs from structure perspective. And some of the popular jurisdictions before Gift City that were used to access Indian markets were Singapore, Mauritius, Dubai, Luxembourg. All these jurisdictions had their own challenges. While they were available for exposure, Singapore, for example, has a requirement that once you set up a fund in Singapore, your minimum spend in Singapore has to be US dollars 200,000 per year. So it tends to be an expensive option per se. Mauritius, again, after the treaty being modified, the advantage that Mauritius enjoyed is in a way gone. Dubai, DIFC, while a very popular jurisdiction, until recently, until end of 2024, it was under the grey list of FATF. Luxembourg was mainly, I mean, the tax treaty of Luxembourg and India was not very favorable for equity investment. It was very popular for making debt investment. So a lot of debt funds used Luxembourg, but it had its own challenges with equity fund. Cayman Island, again, a reputational problem there. So once this Gift City was launched, I think, how does it answers all these questions? What a typical gift structure looks like. So there is a foreign investors globally located somewhere. And then there is a gift AIF, which is in this SEZ zone, the IFSCA zone that Kinjalbhai just talked about. If you are in a DTA zone, you don't get these benefits. You have to be specifically into that gift IFSC zone. That gift IFSC fund will then make investment into your domestic fund in India, which is SEBI regulated, or through that gift IFSC fund also you can directly make portfolio investments, but for an Indian company that will be treated as an FDI coming in. What are the key components? Investment manager and sponsor we spoke about, which are more focused on your domestic AIF, but as in to regulate that gift entity, gift fund, you also need to set up a fund management entity in Gift City. It is not there a domestic investment manager can manage the activities for the gift fund. So trustees, of course, I mean, a lot of these trustees are opening these branch offices. They are not setting up a subsidiary companies there. They're opening up their branch offices from the domestic mainland into Gift Cities, and same entity is regulating both the funds. So this is a typical structure here. It gives you all the benefits that other jurisdictions provided, but does not have the challenges of those jurisdictions there. So in a way, Gift City today is an answer to your global offshore jurisdictions, and a lot of media coverages that this jurisdiction is getting lately. Key differences, what are the differences between your domestic AIF and your gift registered IFSC AIF? Firstly, the regulator in the domestic AIF is SEBI, regulates this domestic AIFs. And in Gift City, it is IFSCA, which is International Financial Service Center Authority. The regulations are more or less very similar. The IFSC has adopted a lot of key points from SEBI regulations, but to provide that convenience to international investors, it has made certain carve-outs there. Regulated entity. Under the domestic regime, under the SEBI regime, it is the fund entity that is regulated by SEBI. So all your filings, all your reportings to SEBI are from the fund entity needs to be made to SEBI. All your quarterly compliance reports, your monthly compliance reports, your trustee reports, everything is for the fund entity. While in Gift City, IFSCA regime, your fund management entity is regulated entity there. So unlike your SEBI regime, your investment manager and its compliances and what kind of actions it has taken over the quarter or over the month, and what is the, say for example, what is the capital raised, what is the capital deployed, what is the situation on employment, what is the situation on infrastructure, everything from the fund management entity goes in your filings to IFSCA. This they have adopted from Singapore ecosystem, where in Singapore your investment manager is regulated instead of a fund. Gift AIF again, I mean the domestic AIF again is mainly inbound. It is mainly to deploy capital for Indian portfolios, Indian companies. Of course, I mean as we saw earlier, there is certain amount of international investment, cross-border investment possible, but with approval of SEBI. But there are a lot of challenges there. For Gift City, it can be used both inbound and outbound, and lot of funds are structuring these vehicles in Gift City for outbound investments as well now. Under a gift regime, for an investor to participate into an AIF asset class, your minimum ticket size is 1 crore. For employees of the fund or the fund manager or the sponsor, the limit is 25 lakhs per employee. Under Gift City regime, the minimum ticket size is there. For retail schemes, it is $250,000. For non-retail schemes, it is $150,000. For employees are again concessional limits available. But there is also, I mean, all investors may not be willing or may not be able to take up this 1 crore of exposure. So if you are an accredited investor today, you can invest a lower ticket size. The thought process here is that the investor should have that risk appetite to take exposure to this asset class. That is where this limit has been set a little high. That somebody with a corpus of say 2 crore rupees today wants to take exposure into an AIF structure. The minimum ticket size is there, say 1 crore, 50% of your net worth or 50% of your corpus, you are taking exposure to this asset class. For some reasons, if the desired returns are not generated, then it's a huge risk that you are taking. So SEBI in a way wants to protect this investor, so it wants to make sure that the investors taking part in this asset class do have certain amount of net worth and have that risk appetite to take exposure to this asset class. So what is an accredited investor? It is defined under domestic regime and gift regime both. So under domestic regime, for individuals, HUF, family trust, if your annual income is 2 crores, or if your total net worth is 7.5 crores, wherein 50% of it has to be in financial assets, then you are an accredited investor. Or if your annual income is 1 crore and, so this is and here, cumulatively your net worth is at least 5 crores with 50% in financial assets, you are deemed to be an accredited investor, and with that accreditation you can take a exposure of lower ticket size in an AIF as well. In Gift City, the annual income criteria of $200,000, $1 million of net worth, or annual income of this needs to be in USD, so or annual income of $100,000 and a minimum net worth of 500,000. So this needs to change here. Yeah. For body corporates, a net worth of 50 crores is required to be deemed to be an accredited investor. For partnership firms, each partner has to individually fulfill this criteria. There is no defined limit for an entity itself, but each partner has to individually fulfill this criteria. So if this criteria are fulfilled, those investors are treated as accredited investors, and that accreditation can enable you to take a lower exposure in an AIF. What are the key compliances? First, let's look at SEBI compliances. SEBI AIF regulations 2012 amended from time to time, circulars and notifications govern this. PPM to be certified by merchant banker, that is what we saw. This is an annual activity that needs to be done at the time of an application. The first certification is received. Annually after the close of financial year, by 30th April, PPM, the merchant banker has to again certify if there were changes carried out in the PPM, if the key terms were changed, and if those key terms that are being changed are duly authorized by the investors or they are in lines with the SEBI guidelines, is something that annually the merchant banker needs to certify. There are certainly, for category 1, category 2 funds, it is quarterly report. For category 3 funds, it's the monthly report. More or less the reportings are same. It's a detailed report that goes to SEBI and trustees as to uh, what are the commitment raised, what are the capital calls made, divestments if any made, categories of investors. So it's a detailed report that goes. These reports need to be submitted within 15 days from the end of the quarter. Valuation of portfolio companies of late, SEBI has been very aggressive, I would say, in terms of publishing the guidelines as to how this valuation needs to be done and what are the standards to be followed for this valuation. This valuation of portfolio assets has to be done every 6 monthly, but with approval of 75% investors, you can extend this term to 1 year. While SEBI gives you an option to extend this term to 1 year with approval of investors, under gift regime there is no option to extend this term. It has to be mandatorily done every 6 months. Units to be issued in dematerialized form. This has been around for a couple of years now. So earlier the investors of AIF were issued physical units. Back in the day when we used to have physical share certificates for private companies there. So earlier unit certificates were issued in physical form, but from since last 2 years, SEBI has made it mandatory that all units of AIF also has to be in dematerialized form. So you have to enable those ICINs and get your RTAs on board for your units. This is for my incoming investments that my investors needs to be issued. For my outgoing investments as well, all investments have to be in dematerialized form only. So this until from last year, all private companies are mandated to get their securities dematted. But there were certain small companies which are exempted from that requirement still. But if there is an AIF which wants to make investment into that portfolio company, it cannot make investment in physical form. So just because of that, that particular small company will also have to get its securities dematerialized. It has to be mandatorily in demat form. There is no option of doing it now in physical form. Changes in terms of PPM to be certified, we spoke about that there. PPM audit. So while there will be other regular audits, your annual statutory audits, your GST audits, your tax audits, the terms of the PPM has to be audited annually. This can be through a chartered accountant firm or a legal firm again. The whole idea here is whatever the terms of the PPM are being submitted to SEBI and which are being published to the investors, whether those terms have been adhered to. Benchmarking of performance. Again, the idea here is to, I mean, as I said, since this is a new block on the kid, government also wants to collect a lot of data as to what is the scenario happening around the ecosystem, what are the performances of the various funds that are operating in the market. This is a 6-monthly exercise that is being conducted. CRISIL and NSE are two benchmarking agencies which are being given this task of doing the benchmarking exercise. So these agencies are collecting data from various AIFs and publishing a report on 6-monthly basis. And you mandatorily have to subscribe to it, and you can't say that I don't want to give my data for benchmarking purposes, and SEBI comes very strong on that if there is a negative report from these agencies. Accredited investors we spoke about, it helps you to get lower ticket sizes. KYC for customers, very, very important. No unknown source to be able to deploy capital here. So we all know this. These are all regulations prevailing in your public market investments right now, and these are being same extended to AIFs as well. SEBI's scores portal to be monitored very regularly. If there are some investor grievances, you got to attend it on priority. Cyber security, cyber resilience framework. Today, coincidentally, is the last day to comply with that. This was supposed to, supposed to be adhered before 1st April, but lot of unclarity as to how it is to be implemented. So with all extensions happening, 31st August 2025 today is the last day by which you have to comply with your cyber security and cyber resilience framework. What is this? Basically, if you are a fund or a AIF fund, your investor data that needs to be protected, that can't go uncontrolled, your encryptions, your firewalls, how you are sharing data across all stakeholders, whether the stakeholders, the recipient of the data, do have those checks and balances in place, is something that you need to implement there. So now, and from last year, there is one new requirement that has come, that the key investment team member, at least one key investment team member of the investment manager, needs to be certified under NSIM's 19C, 19D or 19E examination for AIFs. So earlier when we floated our first fund, there was no requirement there, but that has to be, you have to give this NSIM exam. But until from last year, there was a time limit given that all existing funds to comply with this requirement, and one of the key team member has to take up this exam. And for new funds that are being applied for now, before making an application, you have to have somebody who is taken up this exam, and the minimum passing requirement here is 60%. Why are 3 different series is here? Earlier 19C was a common examination for category 1, category 2 and category 3 funds. But with lot of representations made, lot of differences in their operational modalities, SEBI came up with a requirement that 19D is now focused on category 1 and category 2 funds, and 19E is focused on category 3 funds. So if you are with multiple funds launched, if you have category 1, 2, 3 available in your portfolio, better to go for 19C examination, which caters to category 1, 2, 3 all jointly. But if you are focused only on a particular category 1 and 2, or only on category 3 separately, you can choose what kind of an examination you want to take. Trustees, beyond SEBI reporting, trustees, because they have under investment management agreement passed on lot of rights and responsibilities to fund manager to for conducting day-to-day operations of the fund. Trustees will require certain reports from you. So it's an annual compliance report that trustee needs within 30 days from the end of the financial report. Plus, as and when you make investments or you raise funds, there are certain quarterly reports that also trustee will require. Beyond SEBI and trustee compliances, income tax compliances are something that we are doing in and out. So specifically focused on your funds, your annual tax returns, audits, transfer pricing. 64C is the statement of incomes distributed by the fund to the investors, which needs to be issued to investors before 30th June. 64D is a consolidated data of income paid or credited by the investment fund to all the investors, that this form needs to be uploaded by the fund on the tax portal. Specified financial transactions, if any of your transactions are getting under those SFTs, you got to comply by 31st May. Plus your routine TDS returns and everything of course is there. FEMA we spoke of, if you are taking some investors, some foreign investors directly into your domestic AIF, then there are certain compliances that you need to do. Form INV6, Form DI, FLA returns, or if you are making overseas investments, then reports on those investments need to be submitted to SEBI, to RBI, sorry. LEI is again, this is a very popular thing we all would be knowing. If there is a single payment transaction of more than 50 crore happening, you need to have this LEI number. FIU registrations, PMLA Act, Pinjalbhai sitting here, he keeps guiding us with these things. Gift City compliances, beyond these routine compliances that will also entail into Gift City. What are the key compliances here? So I mean, for Gift City, the regulations that are applicable are IFSCA, fund management entity. You see, if you notice there, earlier it was SEBI AIF regulations, so it was the AIF was being regulated here. The regulations under GIFT City, as we see here, are again the fund management entity regulation. So all these reportings to GIFT City that are happening from the perspective of fund manager and not the entity itself. So certain filings and reportings on once you receive approval. So on approval, you got to intimate about your commencement of business. You got to apply for certain registrations which are not applicable in domestic regime, because since this is an SEZ regime, certain import exporter code that you need to have, eligibility certificates, your LUT bonds for GST, etc. You need to apply for. Intimation of first closing, again, that we spoke about. A lease deed to be registered. So under the process, you can't lease any premises in IFSC until you have the preliminary letter of approval. So lease deed is executed by the developer or the landlord only once you have approval from the authority to set up that unit. On monthly basis, your monthly performance report, your service export reporting form is there. Quarterly basis, of course, there are quarterly reports there. That comes with your letter of approval as to what are the compliances and filings that you need to do. And annually, here your audited financials and average summary has to be, while your law today provides us for audits timeline of 6 months from the end of the closure of financial year. For GIFT City, these audited financials for the fund have to be given within 4 months. So 31st July is something that you should look at. Investor reportings we spoke about. There are no defined reports that needs to go to investors. No regulations define what are the reports. But there are some popular reports that are prevailing in the market. Of course, your tax statements and NAV reports are something that all funds needs to issue. Some institutional investors may require certain specific reports for their purpose. As we talk about, there are certain banks, insurance companies taking exposure to the asset classes. So beyond some regular reports, they will need something for their detailed MIS reporting as well. Periodic newsletters, industry updates, updates on your portfolio companies, etc. is something advisable to share. Having understood this, what is there for us CAs in there? So one is, of course, your AIF structuring and support services that we all can look at. Drafting of your PPMs, your tax advisory, the waterfall distribution model that we spoke about as to if the fund, when the fund gets the exit money realization, how that money is distributed to the investors and the fund manager. So that modeling is something that we can look at. Merchant banking and valuation services is something that we can all look at. Deals and portfolio managements. Once these investments are made, a lot of investments for category 1 and category 2 funds are going into startup companies. So how can you engage with these startup companies, again, is something that we can look at. So on your business plan preparations, your financial projections, your investor decks, how the startups can pitch to the investors, your MIS reviews, your due diligences. So a lot of due diligences are being conducted by this CA firm. So something due diligence practice is something that we can look at. Forensic audits is something that is getting a lot of demand here, because last 2023 and 24 we would have seen a lot of write-offs happening for the larger funds. So funds like Sequoia, Excel have been taking a lot of write-ups, and for their existing portfolio companies, they have been looking out for forensic audits, and to make sure that something is not going wrong that is not usually captured in your annual audits there. Internal controls, SOP is something that all related to portfolio companies management that we can of course look at. And the last part is fund administration that we spoke of. Your fund accounting, maintaining your books of accounts for the fund, computation of your NAVs, your tax and regulatory filings, FATCA and CRS is something that we should look at. And IR is a huge function there. So something that to ponder upon. So with that, thank you guys. Thank you BCSC. Open for questions.
Thank you, Kinjal bhai. Thank you, Shreyas bhai. So we are open for the questions. Any questions? Yes, sir.
Books of accounts are maintained in foreign currency. We do it in foreign currency, but for your reporting purposes, at the end of the year, auditors are going to convert it to INR. So for investor reportings during the year, all your quarterly reports, monthly reports will go in foreign currency. So at the end of the year, for domestic reporting, for your income tax and for your IFSCA, it gets converted to INR. Yes. No, if it is not applicable, you can follow the regular accounting standards.
What is the main reason for success of AIF? Number one. And number two, why the amount kept is so high, say 1 CR? So you said 25 lakh in some of the cases. So if you can just tell that, which are the cases? Like can a common investor put in 25 lakh rupees?
So 25 lakhs blanket limit is only for your employees of the fund or the fund manager or the sponsor. For the common investor, 25 lakhs is permissible, but provided you have that accreditation certificate obtained. So if your income criteria and your net worth criteria allows you to be treated as an accredited investor, and you have got that accredited certificate from accreditation agency, only then you can take exposure less than 1 crore. Why there is a limit of 1 crore? As I mentioned that SEBI wants to ensure that there is a sufficient risk appetite that investor can take to take exposure to this asset class. They don't want all small investors, retail investors taking exposure to these asset classes. Again, while category 3 is usually more public markets related, where you have those liquidities, category 1 and category 2 are more focused on your private market investments, where liquidity is a challenge. So if there is an retail investor who is taking exposure to this asset class and requiring an exit, it may not happen overnight. So exits is a little bit challenge from category 1 and category 2 perspective. So before you take exposure to this asset class, is something that you should be aware that you are investing your play money into this. While you have exhausted all your other asset classes that you need to take exposure to, is when you take exposure. Why? What is the reason for success is that you asked. Again, this asset class gives you access to some investment opportunities which otherwise as a retail investor was not accessible to you. So private market investments, startup investments is something that was not accessible to the investors. It was only public market investments or government bonds that were available for investments. So with lot of investors getting access to this, they are taking this AIF routes because they want a pie of share in the profits that are generated in private market ecosystem, private startup ecosystem as well, which otherwise is very difficult to get access. It's not impossible. So as an investor with 1 crore of a corpus available, I may be able to take direct exposure in maximum 2 or 3 companies. But if I am taking an AIF route, I can spread that capital of 1 crore across 15 to 20 companies, where what is a typical portfolio size of an AIF. So you are diversifying your risk, you are getting the helps of the professionals. So it's same like mutual fund. I mean, while you can always make direct investments in market securities, mutual funds has been doing good because there are professionals running it, your risk is diversified. So same is the AIF is a mutual fund for private market, I would say. You are taking help of your professionals there, and you are diversifying your risk.
I have one question.
Private credit fund is different, no?
Private credit fund is again different. It is also a form of an AIF. It is more of a debt securities against the equity securities there.
Just wanted one related question. What is the process of getting the accreditation certificate? How do we go about it?
So
Actually?
there are accreditation agencies nominated again by SEBI. So I think NSE also one agency that does that. You got to make an application there, and basis your net worth criteria and your tax returns and all, you get that certification.
So if the investments are to be made in Indian market by and the investors are foreign investors, which one is better? Like whether they should invest in Indian AIF or through GIFT City and then feeder fund they should invest into Indian AIF?
So again, no clear yes or no answer. If the investor, foreign investor, already has some roots in India for its other investments, if it is already exposed to Indian compliances and tax regulations, it is very indifferent per se for him to invest either through GIFT City fund or a domestic fund. But if it is a say not an NRI investor, if it is a foreign citizen who does not have any roots in India and wants to take exposure to Indian market or Indian ecosystem, it is always advisable that it comes through GIFT City vehicle, because tax compliances are minimized here. You don't need to obtain your PAN number. So one of the most important thing here is that if a foreign investor is making an investment in direct domestic AIF, to at the time of repatriation, for him to avail the treaty benefits, he needs to give this TRCs and also needs to have a PAN number here, because your TDS returns require that. These people are very shy in taking these PAN numbers in India. So if you are coming through a gift vehicle, usually this PAN number requirement is not there. So depending upon your other exposures there per se, you can take the call. If it is, you don't have any roots already in India and this is the first exposure you are taking to an Indian market, I recommend that you come through a GIFT City vehicle. Also as a fund manager or also as a fund, if they are coming through a gift vehicle, there are less number of filings for me. I mean, that is an vested interest for a fund manager. But from investors' perspective also, yes, it is better to come through gift vehicle.
Any other taxation benefit, like withholding would be there?
Withholding will be anyway there, whether you are coming through a domestic vehicle or a gift vehicle. But I think Jugal Bhai will take that question in detail there. But the rates, I mean, what DTAA benefits, whether applicable, not applicable, certain will vary basis of domestic AIF and gift AIF.
Has to comply with certain regulation. You just now sorry, AIF in DTA area, the fund entity, the AIF which is making investment in those entities, they have to comply with certain SEBI requirement or not?
So you are asking whether a domestic AIF making investments into portfolio companies?
Right.
So if it all is your ROC compliances that are applicable, whether it is a private placement or a rights issue that you are subscribing, or it's a CCD you are doing. So beyond intimation to your investment committee, your trustees and your quarterly filings to SEBI, there is no specific reporting at the time of investment that you do make. It is just from portfolio company perspective, your ROC compliances has to be catered to.
Hello.
As such, there are no minimum requirement, but when you apply for registration, you have to give expected value of export of services, the commitment in terms of the foreign currency that you intend to bring into India. So, but that is not very hard and fast that if those targets are not met, there are any regulatory actions. But as such, it is not there. But the only thing is, the cost of setting up in IFSC is a bit higher, which is comparable to, I would say, BKC in Mumbai, which is the highest in India. So when you go to GIFT, if you are not anticipating those kind of revenues, the cost will not justify your setup cost. No, the chartered accountant services are never through AIF. They would be through either your consulting company, which is in the form of private limited or LLP, or a branch of your chartered accountant firm. So you can go through either of these mode. Most of the people prefer to set up consulting firm in the sense that there are some tax advantages, and you can have investors which are other than chartered accountants coming in and joining you. So in that sense, it is advisable that you form a private limited or an LLP in GIFT City IFSC zone and provide your export of services through that. Unless you are going to do an attestation function, then it is difficult. But most of the services are not in the form of attestation function, especially in terms of export of services.
Kinjal bhai,
Yes.
on the gift city part, you talked about various sectors who are there in the gift city. Okay, I just wanted to know if there is any provision in the gift cities with respect to the health and medical care sector.
No, health and medical is not covered as of now. But support service to health and medical would get covered under ancillary services. So as a chartered accountant, if you are going to offer your accounting services, management consulting services, that would get covered. But health and healthcare is not covered as of now.
Any particular reason why?
They are not financial services, no? They are targeting financial
No,
services.
but it's an export of services. The health sector
No, no,
is.
correct, but as of now, what the government has envisioned it to be a financial service center.
Okay. Not thanks.
So on that,
international group coming in, because that is the angle of financial services. Or if they are having global services, then you can do bill discounting. Again, that is the financial services at group level. I'll cover some of these models, but that is what it is. You cannot transfer your exports over there for the tax holiday period. That is what people want to do, because surely there is a 10 years tax holiday, but that is not the objective of the zone. Also, on the previous question of chartered accountant being set up, an individual chartered accountant cannot set up, because in an SEZ it should be a company or a separate legal entity. Second, there is something which is called as bookkeeping, accounting, taxation regime, which is there in GIFT City, which permits you to provide these services, but not as a branch of an Indian entity. You have to have a necessarily a separate legal entity over there. So that is a ring fencing which has been required, and there are certain nuances in terms of what are the activities can be covered, but largely the speakers have covered them. Thank you.
thank you, Jugalji. Today, CA Kinjal Shah and the team of Shreyas Trivedi had jointly covered the nice area of AIF. Kinjal and both have covered very good in the regulatory aspect and overview of the GIFT City, DTA, ACZ, and guidance on setting of how to set up AIF for structuring AIF, key documentation required, and types of AIF like 1, 2, 3 categories, and compliance regulatory, and lastly scope for the CA. They both have explained very nicely. They also replied the questions of the audience very nicely and in detail. We are very much thankful to both of them. I request you all to give loud round of applause to both of them. Yeah. Now I request Shreyas to give a well-deserved word of thanks.
So we are privileged to have Kinjal bhai and Shreyas bhai with us to share their inputs on AIF and GIFT City. Being relatively new topic, so both the speakers have explained the concepts from basic and then taken us to nitty-gritties on AIF and GIFT City. I think it helped all of us to form the strong understanding of these concepts and explore more opportunities in this space as a service vertical. Request all the members to extend a huge round of applause to these learned speakers.
Now there is a break of for 10 to 15 minutes.